Australia's agritech sector is at a crossroads. Global momentum is building, but at home, traditional funding models and slow commercialisation is holding us back. This session will ask the big question: will Australia lead or let this opportunity slip away? We'll hear about the urgent steps needed to unlock our agritech potential. Joining us are some of the most influential voices in agritech investment and innovation. Sarah Ballawader, Investment Director of Builders Vision; Rob Russell, Partner at Emitech; Mark Gostowski, Co-Founder and Chair Investment Committee of Mandalay Venture Partners; Dr. Nancy Shellhorn, Co-Founder and CEO of Rapid Aim, Biodigital Crop Protection; and Phil Moore, Partner at Main Sequence, who will be facilitating the discussion. So please welcome Sarah, Rob, Mark, Nancy and Phil to the stage.
Okay. Hello, everyone. Great to be here today. So we're here to talk about Australia's agtech moment with the provocative question: is it time for us to lead or time for us to lose? Of course, the answer is to lead, and that's what we're going to explore together today. Our opportunity to lead this field is huge. We're the climate crisis labs of the world. 70% of our land mass is arid or semi-arid. It's forcing us to innovate in areas that the rest of the world is going to need. We've got 40% of the world's population on our doorstep. It's an incredibly abundant opportunity for us here to lead. In terms of funding, however, we have one of the least subsidized ag sectors on Earth. But arguably, this has created one of the most entrepreneurial industries in the world, which the rest of the world looks at with admiration and opportunity. This is a strength. Now, in venture capital, which we're going to be talking about today, as well as other funding sources for agri-food companies, it's been an interesting time. Like all areas of venture capital, arguably except for artificial intelligence at the moment, we've come off the boil a little bit since 2021, with a lower number of deals each year since 2021. However, there were 793 deals globally, which is a significant amount, and $6 billion went into agri-food companies. The good bit of news here is that the capital is starting to flow into more mature companies. We're starting to see bigger and bigger rounds, and exits are happening. There were only 35 exits, though, last year, and I think we've all got to believe that exits are going to continue to grow as this exciting industry matures and companies reach the scale that exits start to become attractive at, because this is going to be the pull that causes the rest of the system to come to life. And we'll talk about some of those things today. So we've had an introduction to the panel. We can't stop talking to each other, I've got to tell you. We're having a great discussion already. The panel is interesting because we've got lots of different contexts. Myself, I'm a partner in Main Sequence, a deep tech fund. 20% of our fund is in agri-food. And we're about $1 billion under management, so quite a lot flowing into the agri-food space, but I come from a general deep tech perspective. Sarah Ballawader is coming to us from a US VC firm called Builders Vision that we're going to hear all about. And obviously in the US there are some environmental contexts which are going to be good for us to understand, because I think the US is leading in a bunch of areas. We've got Mark Gostowski, who's the managing partner at Mandalay Ventures, a brand new VC fund. We need more of them. We're going to hear about Mark's journey there and what he's learning as a VC in this space. Rob Russell has come all the way from the beautiful Vancouver Island to talk to us about his work at Emitech. Again, some very good precedents for us to learn from here in Australia. And Nancy Shellhorn is joining us from Rapidaim. And Nancy and I have known each other for years, but of course she's a very important voice on this panel because in the end, the funding is flowing to organizations like hers, and we're all here to help her and other companies like hers to be successful. So let's get into it. That's enough rambling from me. Where I want to begin is we're going to explore the whole funding environment, and we're looking at what we've got today, and we want to understand what that should become and what we're seeing it becoming so that we are going to lead, we are going to be successful. And so let's start with you, Mark, if I may, and just talk a little bit about what is the funding environment for an agri-food company here in Australia today? What have we got?
I think the first calls are not too dissimilar to traditional startups in that we invest at the early stage, seed to Series A, and a lot of the companies that we see have either taken on some angel investment, either through proper or syndicated angel networks or individuals, friends, fools and family, that might sit as the very, very early investors on a cap table that perhaps might put collectively anywhere between sort of $100,000 and $500,000 into a business, perhaps more towards the smaller end in the ag space. Then we see a lot of the traditional early stage VCs. There's us, Mandalay, there's Tenacious and a few others in Australia. Not too many, actually. It would be good to see more in the category that will invest at the early stage, along with family offices that are actually starting to take a much more proactive approach in investing at the early stage. But a lot of the family offices that we see often will like to take follow a deal lead into a deal because they don't necessarily have the domain expertise to diligence a deal. So we're seeing a little bit of that too.
Can we just pause on that for a second? Because I think that's important. I'd like the audience to sort of understand it. This whole concept of a lead, what is it and why is it important that there's knowledge and insight?
Yeah. So I guess the ag tech category is relatively new in Australia, and it takes a certain amount of expertise and knowledge of the sector and the verticals within the sector, whether they be upstream, midstream and downstream, to understand the business model and to understand how to price a company and to understand what the market opportunities are. And I think what we're seeing is that there is an appetite for ag, but a lot of the larger generic funds perhaps don't have the domain expertise required to actually do that very, very sophisticated and deep dive diligence. And so a deal lead will do that. A deal lead might have that level of domain expertise that can bring others along. We often do that with the deals we conduct where we take a lead position and we give that confidence and I guess the understanding to what might be a sort of a less sophisticated investor in that vertical, some comfort that a group that perhaps has a level of deeper knowledge is taking that lead position.
And just quick, so Nancy, out of every 100 investors that you speak to, how many of those say to you, when you've got a lead, come back and see me?
It's one of the biggest challenges, Phil. We'll often get investors who are really excited to join the round. It's very rare to find those who will lead. The biggest challenge. And I'd say that my other colleagues who are also founders, this is something that founders lament and talk about quite a lot. How can you find that lead?
So coming back to you, Mark, it's really important, isn't it, that we have these comfortable, knowledgeable, catalytic investors here in Australia that know how to take that in first investment. I mean, let's face it, the companies at the beginning they're not perfectly polished. Like, we have to look at them in terms of what they can become, and you need the knowledge to do that.
Yeah, we prefer to deal lead on the deals we do. If there's another lead, we'll conduct the same level of diligence in any case.
Yeah.
But it is an early category, so we're yet to see the generational VCs in the space. We'll get there eventually, but yes, at the moment, there's probably room for a few more of us.
I'll just add one clarifying point on the lead. And the lead is basically the one who takes the pricing risk on the opportunity. And as we heard from Olympia a couple panels ago, that is a big philosophical jump for a lot of investors, to be the one to put your neck out there and say, I believe this company is worth this much under these circumstances, and wave the flag for it to try and attract additional capital. So that's sort of the philosophical difference between the lead and a lot of the follow-on investment, and particularly in circumstances and economic conditions where the amount of capital, the velocity of capital is depressed. It's understandable why you might find less people willing to stick their neck out in that way.
Yeah, it's particularly intense, that dynamic at the moment, isn't it, as the market is in a little bit of a dip generally across VC.
Yeah, and there are legitimate reasons for that, with prime rates going up to basically make the risk-free rate more competitive with the hurdle rates of venture capital funds. Compressed amounts of capital from investors into investment funds basically reduces the impetus for those investors to go and spread out capital amongst companies. So that is starting to unwind, as you mentioned, and I do believe that there are quality deals that are being done in lower volumes.
Yeah. We're going to come to some things that Sarah's been doing to sort of stimulate that a bit later, but I don't want to steal that moment yet. Mark, just before we move on, all the money doesn't come from venture capital, though, does it?
No.
What are the other sources of capital?
We're seeing more and more as the group, and I'm sure the audience knows, that the RDCs are playing a much larger role in constructing their own funds and working with managers to deploy their capital. Sovereign wealth funds, so we're seeing small sovereign funds pop up from the various state governments, Victoria, Queensland, I think South Australia was in there a bit early too. So we're seeing capital there start to move into the earlier stage, which is actually really good. And then the universities, so universities and university partnerships who have their own funds as well. So they're generally the sorts of capital sources we see early on.
Yeah, great. One of the other things we do at Main Sequence is, especially if a company is very hardware driven, we now like to target about 50% of that company's capital coming from non-dilutive sources, so grants, debt when appropriate, a little bit later down the track. But we find that from an investor perspective, that sort of de-risks things quite a lot. It softens the blow, but it feels important that founders can understand all those other sources of capital. So Nancy, let's go to you. What's been your journey through this space, and how have you navigated the different sources of capital? And where's it been good, and where have you hit kind of frictions because of the design?
So our capital is mostly a mix of VC capital and family office. It's a really nice balance. Family office timelines seem to be more relaxed, and we'll come back to that. In addition, we've had some success also with grants through accelerating commercialization, and so it's really helpful to have that mix. And I'd say Australia is unique in that the R&D tax credits, when you're a new innovation and you are proving, if we think about you're first proving your technology platform, and then you're proving the market, and then you're, scaling, in that space where you're proving that technology, to be able to, and you're the one that needs to do it. You can't handball your technology to somebody else to test it. That's not the right time. But having that R&D tax credit where your dollar investment into your R, and mostly in a startup, I'd say it's a lot of D, far more D than R. It's often, you've done the R to get there to begin with, so you have all this development time that you're trying to refine. The R&D tax credits really allow you to get that money back on that dollar spent. It's about a 36%, I think, that you get back, which is fantastic.
When I imagine the kind of board packs of a number of the companies that I'm on, they look like they go down and then they go up, and then they go down and then they go up. And actually the result of that, which is profound, is that the cash out date of a company is probably a year later that you can get something done. Yeah. And it's unusual globally, isn't it? Not many people have this kind of support.
It is.
What about other sources? Like, how much government money have you taken, for example, from grants, from RDCs?
So there's a government program that was called Accelerating Commercialization, and that was a dollar for dollar match. And that was very much about, you had a prototype trying to get it into market. So we took about 500,000 there, so that was very helpful. Right now, there's something called the Industry Growth Program. That's basically phase 2 of the Accelerating Commercialization Grant. And that one is about, now let's commercialize that technology. For us, what we're trying to do is basically firmly demonstrate product market fit and refine that value, how we're going to create value with our partners. So those are good ones. RDC money, only a teeny tiny bit.
Yeah.
We've attempted there, but I think there's sometimes a misalignment with timelines where the company's platform technology sits within the RDC space. It's not always aligned. Also, the timelines for some of that traditional RDC capital can be very long. And when you're a startup, you don't need a 3-year grant for something. You need capital unlocked, with very short timelines to hit very clear milestones. So waiting 8 or 9 months to be able to have an answer is very challenging to manage.
And how have you found that with the various sort of matching formats? Like, there's so many grants out there that say match another 50% with an investor.
Yeah.
But how do you get the timing right there?
I like the premise of it. Sometimes it's tragically difficult because, when you might be generating revenue, but you're certainly not cash flow positive. You're matching what you have today, and if it takes 6 months to actually get that grant, you're burning capital down. So it's a moving feat. Sometimes it'd be nice to match with less, but I appreciate the premise of skin in the game, and I think seeing more of that with faster timelines is a great way to continue to support companies.
Yeah, it feels sometimes to me like sometimes our system, though coming from a good point of view, is timed around the needs of the funder, not timed around the needs
Yes,
of the startup. Let's move on a little bit to some of the activities from our international visitors. Rob, can I just start with you on your investments at Amitech? Like, can you just help the audience understand how you look at underwriting and ag tech? Like, you invested in Swarm Farm, for example, great Australian company. And thank you for doing that as a Canadian firm.
Thank you for having us.
How did you look at that? How did you assess the opportunity, the risk? How did you underwrite it?
Yeah, so I think philosophically there's a couple of different ways that investment managers can conceptualize their portfolio of investments as a whole. The way that we think about it at Amitech is that we prefer a highly concentrated portfolio of investments. So think 10 to 12 in our fund, of which we take fairly sizable equity ownership positions and then take fairly active governance roles. And the reason for that is really how we perceive the range of outcomes for ag tech companies is very, very different than those of B2B SaaS companies or AI companies. And what I mean by that is that it's very challenging for an investor who's providing equity capital to underwrite a 100 times, let alone a 20 times return on that investment. The way we think about it is that we would be thrilled if all of our companies did 2 to 4, 2 to 5 times our investment, anticipating that 1 or 2 might not work out. If all of them did that, we would have a top decile fund of any sector, let alone an ag. And that's a function of the exit opportunities in the ag sector. It's a function of the longer development timelines that ag companies have to go through, and it's a function of the seasonality constraints of the end customers. And so investing in ag requires a different contemplation than investing in B2B SaaS or e-commerce or AI or anything like that.
Yeah, great. Well, that's definitely an area we're going to come back to in some detail. Sarah, let's come to you a little bit. I mean, you call your fund a catalytic venture fund. What's different about being a catalytic venture fund to a regular venture fund, if there is such a thing?
Yeah, well, I think it's helpful clarity that we're actually a family office, and so we have a lot of flexibility in how we deploy. I co-lead our catalytic pool of capital where we have pretty much maximum flexibility, where we can take on a lot of early stage risks, but have a fundamental view that we can achieve a market rate return down the line. And so particularly as it relates to agriculture and ag tech, we're a sustainability-focused fund and funding climate change solutions. We think just writing equity checks isn't enough, and in agriculture, you have to get creative about working with your founders of the opportunity to write different types of investments and using the different tools in our toolbox, which we benefit from having that flexibility. So we can invest pre-seed to Series A. We can write creative debt financing, which we find is like increasingly opportunistic within the US and really working with founders who have non-dilutive capital grants from the USDA or the Australian government to help underwrite those contracts. And then we also invest in funds and seed fund managers. And so we find that we can be very catalytic by acting first, doing the due diligence, letting other people follow our expertise in this space, and then really understanding the needs of our partners and being able to work with them to provide a capital source that works for their business model. And we can take a longer time horizon too.
And I think we talked about this need for leads earlier on. There's something your fund does as an LP, which is brilliant. Can you sort of share that a little bit?
So I should clarify that when we're writing direct equity checks, we are not set up as a firm to lead often, but when we are underwriting funds, we will only invest in funds that do take lead positions because we're really sick and tired of funds saying, hey, we invest in this space, but we're going to sit back and with our hands tied behind our back and wait for someone else to lead. We just have had enough of it. And so as we're investing in emerging fund managers, that is a key stipulation for our underwriting.
Yeah.
And so occasionally we will step into a lead position if we have high conviction in the company and we're just not seeing anyone else step up to the plate.
Yeah.
But it's not necessarily the pricing that puts us off from leading. It's being able to be a really strong partner post-investment, we're a team of two currently, and we can't really engage post-investment like we know companies want us to. And so that's often the holdback for us from leading in investments.
Yeah. What would you say to an Australian family office that's considering becoming an investor in in Mendeley Ventures, for example?
Do it. I think so. We are invested in Tenacious, and part of the reason why I'm here, and that has been our first foray into ag tech investing in Australia. We really like the Australian markets for ag tech because there aren't subsidies propping everything up, and like they are in the US. And so the economics matter, and if companies can survive and thrive here, we believe that it should be easier to grow and expand, particularly in North America. And so I think as a new LP in Australia, we've been surprised by how long the cycle is to fundraise. And it seems like LPs are also waiting to see who's going to move, who's going to act. There's an issue of returns and cycling of capital that is hard to solve for. But I think this is a really attractive market, and we're really excited to expand and do more here.
Yeah, I think that, again, that whole lead question is so important. I mean, I see companies all the time that they may have an allocation for a whole round, but that it takes a year and a half to actually get a lead to catalyze the whole thing. And that, that's a lot of money that's just been burned waiting for that moment to happen. Next we're going to sort of move on to the whole sort of fit of venture capital with ag tech. And Sarah Nolette wrote a brilliant piece on LinkedIn, I think it was last week. And the title was, "Is ag tech broken for venture capital, or are we asking the wrong question?" And if you haven't read that piece, I recommend you all look it up, search for it on LinkedIn. It's a fantastic provocation. But the big idea, and Rob, you touched on this earlier, we'll double click on that now, is that there's no one-size-fits-all for VC. We can't look at an ag tech investment, a robotics investment, a biological investment as a SaaS company and measure it the same way and have the same plan. Let's talk more about that a little bit. I mean, what is different about an ag tech investment? I don't know anyone want to have a crack at it first? Mark.
Yeah, sure. I think the challenge that a lot of ag funds have is that the traditional power laws of VC, which is, you might make 50 investments and 2 will do 100x, they don't work in our category, and nor should they be expected to. And we take exactly the same view as Emitech in that if we invest in 20 companies, we would expect, and our absolute expectation is being very hands-on with them and taking board roles or executive extension roles to really support growth, is that a minimum of 2 to 5x gives you around about a top quartile return. You might then get your couple that go to 10 or 20x, and that's great. But the thought that the power laws where you're going to let 80% of your portfolio die and 20% survive 2 or 3 do really well is not how we operate, not how I think the sector is going to be successful. It's going to be much more hands-on, much more proactive, working with companies and expecting more of a PE-style activity in a VC model, where sometimes upstream investments, which might be closer to on-farm, take a bit longer to get to a liquidity point, and we have to be aware of that, and we need our investors to be aware of that. And then downstream investments that might be more around the B2B SaaS space can have faster paths to exit.
Yeah.
And so for us, we actually manage between upstream, midstream, and downstream to have strategies around liquidity. But I think it's very much those original laws around VC don't necessarily apply to ag, and I don't think they should. And I think the best way to work with ag is to actually sit and manage closely with the companies you invest in, and look at reasonable liquidity.
Yeah. Sorry.
I completely agree with that. The other thing that I would say is I think average fund life is 10 years, and that's just not enough time, particularly in ag tech. There is one growing season a year unless you have split the market with the US and Australia. And so to prove scalability and product market fit, you're just not going to get enough time. And so I think that most ag tech VCs should actually be 12 to 15 years, which is controversial and we don't really see it. But I think there's a misalignment of time expectations.
Yeah, it's interesting. I wrote a piece last year where I said we need impatient capital, and lots of people gave me flack about it. But where I was going with that is, because I actually agree with you fundamentally, but there's something interesting about the dynamic that kind of causes velocity, which is where I was trying to go. I mean, and I think to your point, Mark, I think that there's we can't deploy a check and then wait for the magic to happen and wonder when the returns are going to happen. We have to get our sleeves rolled up. We have to get in there. We have to help. And can we help increase the velocity a little bit?
I think from our side, if we can't help, there's no point us being in.
Yeah.
So one of the metrics we have in our process with diligence across all of the normal things you'd say is what value add can we bring to the firm?
Yeah.
And if there isn't any, we don't really have a point being there.
Yeah. Yeah.
I'll maybe just interject there as well. And one of the nuances about how our fund is structured is that we're actually, our investors are from Canada's ag industry. So we have some of the big provincial governments that have a large agricultural footprint. We have big Canadian fertilizer companies, grain handlers, ag input retailers, distributors, equipment manufacturers, and then probably most importantly, we have hundreds of thousands of acres of primary producers who are direct investors in our fund. So when we go and contemplate how to expedite the ag development timelines, and while we're assessing a company that we would like to invest in, we have an interesting platform and an intellectual foil from our LP base, which we can then say, well, how can any of our constituents who are already financially aligned with the potential future success of this business, how can we help them expedite it, as well as taking a lead position, as well as providing them equity capital, as well as providing them sort of strategic corporate governance and that kind of item. And I don't know to what extent that exists in Australia, but it requires people like myself and people like you to go out and pound the pavement and say, if you care about the ag industry in this country, help catalyze it with aligned equity capital.
Yeah, I mean, how incredibly valuable is that? Why would you want Andreessen Horowitz or Sequoia on your cap table when you could be on it? Yeah, with all that infrastructure network that you kind of bring. Can you just talk a little bit about what does that mean for a company? Like, can you give us an example of a company and how it's interacted with that universe around you?
Yeah, I mean, when you think about sort of I'm not going to go into specific details, but at a very high level, if you're a company at the early stage of your development pathway and you say, look, I need to get introduced to some of my potential customers. Well, we have hundreds of thousands of acres that you can go and walk through. They would be happy to show you around, and that's happened many times. If you're a company that has a product in development, we've talked about sort of the importance of the D over the R. If you're trying to develop a product and you need commercial partnerships or field trials or things with corporates, we've facilitated that many, many times. And if you're looking for access to sell your product, you finished the D stage and now you're trying to commercialize, we can facilitate access into distribution channels, retailers, and that kind of thing if that's the path they want to go. So we've done that extensively with our portfolio. I can't actually think of one that we haven't, but it's part of our value proposition in excess of being just equity capital.
Yeah, fantastic. The next thing in Sarah's piece was about founders being clear on their fit for venture capital, and I think that touches a little bit on the investor side that we talked about as well, about the kind of power law is different when we're looking at ag tech versus a SaaS company, for example? Like how, what would be let's go to you, Sarah. What would be the kind of return profile you think a founder would need to be comfortable in wanting to deliver to it before they go and see a venture capitalist?
It's a good question. I mean, there's so many different factors that go into it, and it's a hard question for me to answer because it really depends on like what tool we are using to invest in that company. So right now, I guess I can talk. So like I said, we do direct equity checks. We do debt. Right now, if we're doing first of its kind financing or operating lines, again, we're catalytic. We're pricing things at between 8 and 12% on debt right now, which is a lot lower than what people are going to get when they go to their local bank. And a lot of those are based on contracts, especially if you have like government grant contracts backstopping that. And so that until USDA and the US stopped processing grants last week, that was like pretty assured capital. I think what's also really important on the equity side is like making sure founders have enough skin in the game and are going to be properly compensated and their ownership levels make sense.
Yep.
And so it's working with them to come up with reasonable valuations and making sure that there's an alignment with the founders, that things are priced appropriately, that helps them unlock capital in future rounds, and that they can hit revenue-based milestones that make sense. And so before the session, we were talking about a product that we've been innovating on is, could you do a convertible loan that is a milestone? We're working on milestone-based financing where we've agreed to a dollar amount denominator up front, and we've come up with milestones with our founders that once they hit them, it unlocks X dollars. And so they're kind of guaranteed the money as long as they hit the milestones, but we're not going to be hard and fast and black and white on that because we have an economic interest in the company, and kind of chipping away at it versus giving like a large sum of money up front. That Nancy, I'd love you to jump in on how that kind of slow rollout of money helps set you up for the next round and the priced round, which we have found to be an effective tool for investment.
Nancy?
I mean, I think that's fantastic. If we think about creating the structure of capital that ag tech needs and that seasonality, I mean, one part of it is that, yes, there's each year comes around, but even usually technology or solution to bring better margins for growers is an entire season evaluation process as well. So it's not just that it comes around once a year, but your solution is in the market being evaluated for 8 months, for example, if we're in specialty crops. And so this idea that you have a commitment to cash, you're unlocking it as you hit some key milestones, I think is, for me, it's one of the big take-home messages of what I would like to see. I know we've all been learning a lot as we've been going through and building companies. I would say that this whole game, this space of innovation and how we drive it, and if I could turn back what we did before, that would just be able to structure those key milestones and unlocking capital as you go would be incredibly powerful.
I think that's an area where we can all do better, actually joining the dots a little bit on the timing. We talked earlier about matched funding and the timelines of those things, where if you've got some seasonal outcomes that are going to happen here, but the once a year funding window opens up just before that, you've got to wait another year until you can even apply for the funding. So we're not joining the dots enough, are we?
Yeah, and meanwhile, you're still making payroll each month, right? So let's not forget about that.
Yeah.
And so that's very important. And I think Mark raised a really good point in our conversation about the hero story for ag tech and agriculture. I think it looks different.
Yeah.
And it's still incredibly valuable. Food and food production is the most fundamental thing we do, and there's a lot of exciting innovation about how we can continue to reduce the externalities and we can build and create value with our partners. But the story is not what we often read in the Australian Financial Review, like we do for software companies. So I think, the previous conversation where Olympia and Lee Sales were talking about the stories that we tell, the hero story for agriculture, we need to start to shape it because it does look different. It is exciting. It is about, our fundamentals and foundation.
What is the, if you imagine the hero in ag tech, what does the hero look like?
So if we talk about the space of reducing some of the externalities of agriculture, I mean, so every single day it's so important to have nutritious, healthy food, but we often want it at the lowest price. It needs to look perfect. And often those looking perfect and those low price means externalities that nobody's paying attention to, but we now have to really pay attention to. I think the story in the future is really how impact is huge. Impact for our planet and our people and our producers is huge. That has to be a recognized and a part of that story, as well as growing a profitable business, as well as bringing, and a profitable business, it's not about that, it's about how we create value in the supply chain with our partners. And of course it needs to be, giving a return, but that impact side of it is key.
Yeah. The next part of Sarah's post was on corporates and industry, and she provocatively asked, stop playing VC and play to your strengths. What are the strengths? Like how can corporates get more involved in what might be a fragile early stage company and bring it to life? Mark?
We don't see a whole lot of it, to be honest.
Yeah.
I don't know if you do here in Australia in terms of corporate engagement at the early stage.
Not so much.
In terms of investment or supporting trials or things like that. We see a lot more across Asia, for example, where you've got a lot more corporate VC. I think there's a lack of competitive... I wrote a piece the other day that talked about Australia's lack of competition stifling innovation. And I think part of the dislocation between corporate engagement into early stage, but particularly into ag, is that there isn't enough competitive tension that exists at the corporate level that forces change and forces the need to innovate. And it's across all of Australia. It's not just in the ag. It's banking, supermarkets, the whole lot. There's a lack of competitive tension that stifles innovation and acts as an anti-catalyst to corporate activity. And so I think there's a few corporates that have done some work. Telstra was doing some stuff a while back, but seemed to have pulled away a little bit. We're seeing a lot of Asian corporates coming into Australia. Hitachi, for example, are doing a bit of work here at the moment. But from an Australian perspective, I think we need to see more. How do we do that? I'm not sure. I don't have the answer.
What about you, Rob? I mean, you've got this amazing network. You must be seeing that in your world in Canada.
Yeah, I mean, in the Canadian context, a lot of Canadian agribusinesses are very hesitant to take an equity stake in an early stage company. They would much prefer to help them along their development pathway through whatever way they can. Now, the matchmaking there is difficult because if you're a sort of manager at a Canadian agribusiness, you're not out there looking at the newest technologies and companies that are coming up. You're focusing on your customers and your internal ops and all that kind of stuff. So we recognize that there's an opportunity for us to broker some of those relationships. The agribusinesses have the opportunity to get an indirect equity ownership, support the development and maturation of those companies while keeping the door open for some of those relationships to happen. Now that requires a level of recognition at the executive and even the board levels of some of these agribusinesses for them to say, we're going to write a $3, $5, $10 million check into an investment fund. And while we are looking for a financial return, what we're also looking for is the potential for strategic partnerships, for the opportunity for applied technology in our own business. That is a challenging and a long conversation that has to happen. The responsibility of that falls on us as the fund managers who are going out to ask them for money. I'm not entirely convinced that companies should be expected to have that level of recognition. It requires somebody to convince them.
Yeah, I think, we see a lot now, corporates becoming LPs and venture funds so that as a kind of insight tool, to see the inside of some frontline innovation. Would that be why your LPs are signing up?
Yeah, we make no bones about the fact that we are out first and foremost to make money for our investors, whoever our investors may be. The second aspect is that we are looking for applied technologies from around the world that can increase the profitability and net farm incomes for Canadian producers. Doesn't matter if you produce terrestrial livestock in Saskatchewan or canola or aquaculture, that's what we're looking for. And having LPs that are aligned with the same philosophical approach of, they're looking for applied technologies for the benefit of their customers, for their stakeholders, for their supply chains, all of that kind of thing. That's the starting point. In Canada, we also have fairly considerable crown corporations. I don't know exactly what the equivalent would be in Australia, where they take taxpayer dollars, they run fund-of-funds programs. There's Export Development Canada that will provide export guarantees for technology companies who are selling overseas. You have Farm Credit Canada, one of the largest agricultural lenders and FIs in the country, entirely focused on ag. And then you have the Business Development Bank of Canada. And all of them have fund-of-funds programs that invest across multiple sectors, and they're significant players in the capital ecosystem as well.
And this sort of brings us to the sort of the next point of Sarah's map for this conversation, I suppose, which is Sarah Nolet, that is, that governments can and should sort of catalyze more capital. That's a really good example of something that's happening in Canada. What are we, beyond the R&D tax credits, like what else could we be seeing here in Australia? What works terrifically well in the US, for example, Sarah?
It's a loaded question right now. In the last 4 years,
Sort of.
last 4 years, the federal government pumped billions of dollars into the ag system to foster innovation, particularly aimed at climate-smart agriculture, and it was amazing for fostering innovation. And it ranged from large corporate partners all the way down to smallholder farmers who were recipients of these grants. And it really aligned incentives and provided that capital that farmers and producers needed to take risks on farm. That funding has been paused, and it's causing a lot of problems in the last 6 weeks, and so it's pretty unclear what's going to happen going forward, which is unfortunate.
I mean, I wonder where, I feel like we need more blow softening.
Yeah.
There's a kind of, this environment which in one way is a strength, that we have a generally unsubsidized, entrepreneurial, pragmatic industry here in Australia. The problem is everyone's taking a profound risk when they commit to a new innovation. And that means when Nancy tries to run a trial with a farm, they kind of really want it to work. And if a big corporate's needing to buy it, the same thing. And there's a kind of there's a kind of guaranteeing process that I think would be really helpful for us to think about how to do that. Like, how do we have people to underwrite the risk everyone else is taking? And there's been examples of this in history in pharmaceutical industries and so forth, where whole new important changes have been underwritten in risky environments, and not $1 been paid out because actually everyone gets there. All it's doing is saying it's okay to take the risk. I think is there anything like that I have no idea. Is there anything like that?
Yeah, so I remain unconvinced that the taxpayers through the organs of government are the appropriate allocators of capital on the whole, but there are incentive structures, particularly around the tax side, that governments can put out, like investment tax credits for early stage startups is a massive part of the early stage of the funding pathway for Canadian companies. So that happens both at the federal level and at the provincial levels in Canada. And that is a great stimulus for private capital, family capital, small businesses to invest in early stage companies and start that alignment journey early on.
Fantastic.
We've also seen state sovereigns, like groups like QIC through Queensland Treasury with the Queensland Development Fund, and then Breakthrough Vic and Launch Vic, who are also supporting first-time managers or emerging managers as well, come through. That's very, very supportive because it provides private sector with some comfort that government is supporting some of these activities as well. But I think one of the things that is constantly talked about here and no one's really been able to sort of crack is how do we get our really, really large super funds, which hold enormous amounts of capital, to have slightly larger allocations towards this category.
Yep.
And we were in a discussion with QIC not long ago who are having the same sorts of questions, saying how do we actually release more capital from our huge reserves that we have, and that's something that probably warrants some discussion.
Yeah. I remember when we were doing our first LP discussions with super funds, and one of them sort of said, okay, there are 5 things that are important to us. Make money, make money, make money, make money, and impact. Are the 5 things, and that sort of said the message of what the Australian super funds are thinking. Look, we've got it. Just before we move on to the last bit, I think this is where the National Reconstruction Fund is interesting here in Australia. That some of you may know, it's a new initiative. $15 billion that's been put aside to help new industries grow and to help new versions of existing industries like agriculture. And one of the things they do, which is very interesting, and we've already been touching that, is I think as these companies grow, they need to get to a debt fundable context as soon as they can. So they're not selling their company in order to move forward. They're funding it with debt. And the problem with that is there's a gulf between what readiness for that kind of looks like and where a venture capitalist would tend to take a startup. What's interesting about how the National Reconstruction Fund is working is they've got a higher risk tolerance, but they still expect you to behave like a debt fundable company. And I think that's great. It's going to step a whole bunch of the startups closer to where they need to be. But we've only got 5 minutes left, and what I do want to leave on a high, on an optimistic note. This industry is growing. It's easy to look at a moment and say, "Gosh, it's so hard. There's so many headwinds." When I started in this business in 2013, the entire venture capital pool in Australia was $200 million. That's about the same size as one of the major funds here in Australia for one particular vintage now. Today there's about 8.2 billion available in venture capital in Australia. So it's moving, right? And that's just venture capital. The whole system is starting to grow. So what do we want it to do over the next 10 years? And let's start with you, Nancy, and just move down the line.
Yeah, great. I think conversations like this are fantastic because we're recognizing that the playbook for agriculture needs to be refined. We all want to see these successes happen. And so that structured capital in a way that unlocks tranches of money with milestone bases, and maybe a slower ramp up. This idea, traditionally with venture, you get this load of cash and then run. We can run that fast, but our sector doesn't. And so we've got to align our sector with how we're going to bring innovation into the marketplace and that value creation with partners. So my positive takeaway is having the recognition of this type of conversation is fantastic as we start to redesign that playbook.
Thank you, Nancy. Rob?
I think that the largest opportunity to continue the proliferation of agtech, not just in Australia, but anywhere, is the introduction of financial literacy for agtech for founders. It shouldn't be conversations like this where people are learning about some of these structures and concepts for the first time. That is an amazing spend of government money to provide programs, bring in people from around the world to provide financial literacy, because as we discussed, not every company is a good fit for venture. Not every company is right for debt. What are the structures, processes, and frameworks that founders have at their disposal and not get sucked down the path of selling off too much equity or going down development pathways that aren't going to be fruitful? That's the kind of conceptualization that's going to take Australian agtech companies international and to the next level.
Thank you, Rob. Mark?
We're a small country, and I think all of our startups have to have a global mindset to be successful. And I think one of the things we often neglect, and it's an enormous opportunity for all of us on a positive perspective, is that there's 700 million people between Ho Chi Minh City and Jakarta, which is the fastest growing middle class on the planet with the highest demand for food and food security. And we have a really good opportunity to start to build the bridges into the region. We've just secured our first international strategic LP, Seji Fresh, which is a very large fresh food supermarket chain in Malaysia, 130 stores, huge amounts of volume across this food chain. They want technology access. So to them, Australian tech brings enormous value because of the efficiencies it makes across the supply chain. We can do a better job, and I think it's our responsibility to do a better job at building the bridges into the ASEAN region, because as a country of 26 or 27 million, I think the stat was our food systems feed 60 or 70 million people globally, with the potential for more. There's lots of opportunity for us to build those bridges, particularly in areas like Indonesia, with the hot meals for every child under 13 coming up soon. So there's huge opportunities for food systems.
I think that's another reason why we need more domestic ag-tech focused venture capital funds as well, with LPs that are knowledgeable, that can help, and the whole thing just creates more and more action. Sarah, last but not least.
I think my hope for the future is that there are more investors in the space, just as what you just alluded to, Phil, and that there's an acknowledgement and understanding that venture capital is one tool, but it's not always the best tool or most appropriate tool, and to have funders that can meet the flexibility of the need of the sector. And it is biased, but I do think family offices are perfectly primed to step into that position. So.
Fantastic. Thanks, Sarah. So lead or lose? The answer is lead. Thank you for your time this afternoon.